Welcome back to the Daily Crypto Roundup. Today's stories have a common thread. Regulators are drawing lines, markets are pushing back, and Bitcoin is quietly grinding higher as traders look toward rate cuts in the US. We're going to cover the Bank of England's controversial plan to cap how much stablecoin you can hold, France's push to clamp down on passporting under Europe's MiCA rulebook, and the latest on Bitcoin's rally toward 116,000. Before we dive into the stories, let's check where the market is sitting right now. Bitcoin is trading around $116,000 after a 4% push higher this past week. ETH is consolidating in the $4,600 to $4,700 range. SOL is showing momentum, moving toward 242. XRP is softer, holding close to $3. Avax is steady just under 52. Doge is sitting at a quarter, and Litecoin is around $91. Together, the total crypto market cap is holding just over $4.1 trillion. Let's start with the UK, because what's happening there is striking. The Bank of England has floated the idea that people and companies should face caps on how much stablecoin they can actually hold. If this plan goes ahead, individuals would be limited to somewhere between £10,000 and £20,000, and businesses would face a ceiling around $10 million. The bank says it's about managing systemic risk. In other words, they don't want a future where a blow-up in one stablecoin issuer could ripple through the economy and threaten the financial system. On paper, that sounds like prudence. But in practice, the industry is already pushing back. Groups including Coinbase and several UK crypto trade associations have told the Financial Times that this approach would stifle innovation and put the UK at a competitive disadvantage compared to places like the US and the EU. Their argument is simple. If you cap usage, you don't just block risk, you block adoption. Stablecoins are designed to replace clunky payment rails with something fast, cheap, and programmable. If the average person can only hold up to £20,000 and a company can only park 10 million, you're automatically excluding use cases like corporate treasuries, payroll systems, or fintech apps that need to manage large balances. Think about it this way. If a UK-based company wanted to use stablecoins for paying staff across multiple countries, or if an exchange wanted to hold client funds in a regulated coin, these caps would be a hard ceiling. And once that ceiling is hit, the business would need to move money through traditional banks again. Precisely the inefficiency stablecoins are supposed to solve. The irony here is obvious. By trying to manage systemic risk, the bank could end up reinforcing the system it's trying to modernize. Analysts have started to weigh in. A London-based policy lead told the FT that the real danger isn't stablecoins themselves, but the lack of nuance in regulation. He argued that a one-size-fits-all cap makes no sense, because not all stablecoins are created equal. Some, like USDC or a future UK-regulated coin, are fully backed, audited, and transparent. Others, like algorithmic stablecoins, are inherently riskier. Treating them all the same is like treating a government bond and a penny stock the same. The fix, he suggested, is tiered limits tied to the quality of the issuer. The higher the audit standard and reserve quality, the higher the cap. That's a framework that could balance risk with innovation. And this is where the politics kick in. The UK has pitched itself as open but safe when it comes to digital assets. The Prime Minister and Treasury have both talked about making London a crypto hub, but open and safe are competing priorities. If the Bank of England pushes this plan through without modification, the UK may keep the safe part, but lose the open, and businesses will simply route volume elsewhere, maybe through the EU under MiCA, or further afield in the UAE and Singapore. Which brings us nicely to France, because across the channel, another regulatory fight is brewing. Under MiCA, Europe's flagship crypto framework, companies can apply for a license in one EU state and then operate across the whole bloc. It's called passporting, and it was designed to give Europe a unified market for digital assets. But France is now threatening to block that system, or at least to limit it, on the grounds that some firms are gaming the rules. The French regulator, the AMF, says companies are deliberately choosing jurisdictions with lighter enforcement, like Malta or Lithuania, to get their license. Once they've got it, they use that license to operate in stricter markets like France. To Paris, that's regulatory arbitrage, and they're not willing to accept it. France, backed by Italy and Austria, is calling for the EU's central regulator, ESMA, to take control of licensing for the biggest crypto players. That would raise the bar significantly, because ESMA would impose uniform, block-wide standards rather than allowing firms to shop around. Marie-Anne Barbatlayani, who heads the AMF, told Reuters that passporting under MiCA is very complex, and that the rules need to be re-examined before Europe ends up with a race to the bottom. It's a strong statement, and it's a sign that MiCA, which was supposed to create harmony, could end up creating conflict. Why does this matter? Because Europe is trying to position itself as a leader in crypto regulation. If it delivers clarity, Europe could become the jurisdiction of choice for institutional adoption. But if the bloc fractures, if France and a handful of others start pushing for central oversight while smaller states resist, you get fragmentation. Fragmentation equals friction, and friction slows down adoption. For a US exchange or a UK fintech looking at Europe, this is the difference between a single rulebook and a patchwork of rules. Analysts are divided. Some say France is right, because consumer protection should come first, and passporting only works if standards are equal. Others warn that if ESMA gains too much power, smaller member states will lose their leverage, and the EU could become as slow-moving as the US section. In other words, MiCA could either become the gold standard or another bureaucratic maze. Which way it goes will depend on how this fight plays out over the next few months. Now, let's pivot back to the markets, because while regulators are wrestling with frameworks, Bitcoin has been doing what Bitcoin does best, climbing quietly while nobody's paying attention. Over the past week, Bitcoin has rallied about 4.5%, bringing it to roughly $116,000. That puts it back within striking distance of resistance around 117,000, with support building just under 115.5. What's driving this move? Analysts point to two main factors. First, US macro. Rate cut hopes are back on the table. Traders believe the Federal Reserve will have to loosen policy sooner than expected, given recent inflation and employment data. And risk assets, from tech stocks to crypto, are front-running that possibility. Second, technicals. A CME futures gap around the 115,000 mark has been filled, removing a bearish overhang that cleared the runway for a push higher. At the same time, ETH has been consolidating between $4,600 and $4,700. It's not breaking out, but it's holding firm. Sol has shown more momentum, with buyers pushing it toward $242. That's a level traders are watching closely, because a clean break above it could open up a move into the 250s. XRP, meanwhile, has softened, holding near $3. That makes sense, because traders are waiting for October's ETF decision. Until then, it's a coiled spring. Any hint of approval could send it higher, any delay could drag it lower. Barron summed it up well. Bitcoin is acting like the macro bet. ETH and Sol are behaving like beta plays, and XRP is stuck in a pre-catalyst coil. That division is telling. It shows institutions are comfortable scaling into Bitcoin via ETFs, they're dipping into ETH with some caution, and they're holding back on everything else until regulators show their cards. Kathy Wood of ARK Invest, who has been one of the biggest champions of ETFs, said recently that these inflows are just the beginning. She believes Bitcoin and ETH ETFs will become permanent fixtures in diversified portfolios, much like gold or bonds. Eric Balchunas at Bloomberg backed that up, pointing out that institutional inflows through ETFs are sticky. They're part of retirement accounts and endowments, not just speculative trading. That's why Bitcoin can grind higher, even when retail feels hesitant. So what happens next? There are three fronts to watch. In the UK, the Bank of England will come under pressure to revise its cap proposal. If they soften the limits or introduce exemptions for fully reserved coins, the UK can still claim to be open for business. If they don't, expect capital to flow to friendlier jurisdictions. In Europe, the fight over MiCA passporting could accelerate. If ESMA gains oversight, the bar for entry rises and the EU could become the most tightly regulated market in the world. And in the US, the Fed will dictate whether Bitcoin's rally has legs. A dovish tone could fuel another leg higher, while hawkish language could stall momentum. The big picture is this. We're in a tug of war between regulators who want control, institutions who want clarity, and markets that are trying to price the next move. Bitcoin is benefiting most because it now has the cleanest narrative: ETFs, macro hedge, institutional flows. As always, the only certainty is uncertainty. That's why we stay nimble, we stay informed, and we protect what we hold. I use a ledger myself, and you can grab one through the link in the description to keep your assets safe before CBDCs roll out. That's it for today's daily crypto roundup. Regulators are flexing, markets are adjusting, and Bitcoin is quietly climbing the wall of worry. Drop your thoughts in the comments, smash like, hit follow, and we will see you at the top.